let's talk about a big question. What is capital? Now, if you're like most people, your brain probably jumps straight to money, right? Well, it turns out that's only a small piece of the puzzle. The real definition is way more crucial for anyone looking for long-term success. And here's the thing, it has less to do with how much you have and a whole lot more to do with how long you can last. And this really gets to the heart of it. Capital isn't just a number sitting in an account. It's your endurance. It's your staying power. You see, the markets, they don't ultimately reward the smartest person in the room. They reward the one who survives. Because if you get wiped out, the game is over, period. Doesn't matter how brilliant your strategy was supposed to be. So why is survival such a massive deal? Well, it all boils down to some pretty simple but incredibly unforgiving math. The relationship between your gains and your losses, it's not symmetrical. It's not a one-to-one thing. And understanding this is absolutely essential if you want to stay in the game. Okay, let's just imagine a scenario. You have an investment and boom, it takes a major hit. It drops by 50%. Ouch. That's painful. But it's just a number, right? The real question is, what happens next? Think about it for a second. Your first instinct, your gut feeling, might be to say, well, you need a 50% gain to get back to even. But is that right? The answer is a whopping 100% gain. That's right. You have to double your remaining money just to get back to where you started. This brutal asymmetry is exactly why avoiding huge losses is so critical. The climb back up is always steeper than the fall down. And this analogy just illustrates the point perfectly. Think of your portfolio as a mountain climb. Making steady progress is the goal. But a 50% loss? That's not a small stumble on the trail. That's like falling into a deep ravine. All your time and energy is now just spent trying to climb out and get back to where you were, while everyone else continues their ascent. You know, this idea of falling into a ravine isn't just a nice metaphor. There's a formal mathematical concept that describes this exact scenario, and it's called the gambler's ruin problem. And what it proves is that even a fantastic, winning strategy can lead directly to total failure if you pursue it too aggressively. This is the key definition you need to know. The risk of ruin is basically the chance that you get wiped out completely. Game over. A probability of 0 means you can't possibly go broke, while a probability of 1 means ruin is a certainty. Your whole job is to keep this number as low as possible. So, what determines this risk? It really comes down to 3 key variables. First, your probability of success. How often are your bets right? Second, your payoff ratio. When you win, how much bigger is it than when you lose? And third, and this is the one that most people forget, what fraction of your capital are you risking on any single idea? Now let's look at the hard data. This table shows the probability of ruin when you risk 100% of your capital on each trade. So let's imagine a really favorable scenario here. Find the row for a 60% probability of success. That means you're right more often than you're wrong. And here is where it gets shocking. Even with a fantastic strategy, you're right 60% of the time, and your winners are 10 times bigger than your losers, if you bet the farm every single time, you still have a 40% chance of going completely broke. That is a terrifying number. And it proves that survival isn't just about how good your ideas are, it's about how you manage your risk. Okay, so if betting everything is a recipe for disaster, what's the alternative? It all comes down to a fundamental choice in your mindset. Are you playing offense or are you playing defense? On the left, you've got the offensive mindset. This is all about maximizing returns, finding those huge winners, and it's driven by optimism and, let's be honest, greed. But on the right, you have defense. The focus here is totally different. It's about protecting your capital, avoiding the big losers, and being driven by prudence and caution. And there's really no better advocate for the defensive mindset than Warren Buffett. This famous quote isn't just some clever saying. It is the bedrock of a philosophy built on survival and longevity. He fundamentally understands the brutal math of loss that we just saw. So the crucial point is this. Over a long career, your results will likely be determined more by the number and the severity of your losers than by the greatness of your winners. Superior investing is asymmetric. Sure, it produces good returns when things go well, but more importantly, it resists decline when things go poorly. This brings us to the final actionable idea, adopting the survival mindset. It's a synthesis of everything we've just discussed, from the math of loss to the discipline of playing defense. Let's just state it plainly one more time. It doesn't matter how great your system could have been if you blew up your account before the good times came. You have to be around for the easy markets, and that means conserving your capital during the hard ones.
So what does this look like in practice? First, you manage risk, always. Remember that preservation comes before performance. Good performance is just a byproduct of not getting wiped out. Second, use discipline as your weapon against fear and greed. Third, focus on longevity because that's what allows the incredible power of compounding to work its magic over time. And finally, you have to adapt. Markets are constantly changing, and only those who can evolve will survive.
And that's the final question to ask yourself. Is your strategy built to win a single battle, or is it built to survive the entire war? It's easy to look brilliant in a bull market. The real test is whether your approach is robust enough to withstand the inevitable storms and keep you in the game for the long haul. Because in the end, staying in the game is all that matters.